Hey guys, it's James. What just happened? I don't know. We're still picking through the pieces. Feels like, yeah, it feels really just shocking. Donald Trump just shocked the world, and I'm I'm shocked as anybody. And I think the marketplace was shocked. I think there's a seismic shift in the marketplace as a result of his election. And actually, the market seems to be pretty encouraged by a Trump victory, it turns out. The market is happy. The market's doing very well. And so I guess that's encouraging. But what it means for real estate is something else entirely. So I kind of wanted to go over a couple things with you guys. And I know that I'm embedded in the screen here, but when on my version of this, it's actually down here. So when I'm moving, when I want to look at the screen, I'm going to be looking away from you. But how does the election result impact mortgages and real estate? The first thing that happened was rates spiked. Because of this rally, a lot of money is leaving the bond market, and that causes yields to go up, and it causes rates to go up as well. I think we went up about a quarter point in rate overnight. So that is a big shock to the marketplace. It makes money a little bit more expensive. It reduces people's buying power. And I don't know how lasting it is. Here, I'll show you a chart. This is the Fannie Mae 30-year fixed bond chart, and you can see here this is election night right here, and you can see when these are high, when the bond is selling at a premium, the yields go down, and when everyone's selling their bonds, they have to increase the yields to attract more buyers. So that's why rates are more expensive. So you can see that this was kind of like early October, and we had really good rates here. This is probably a 30-year fixed around 3.5%. And then we kind of slipped into this territory here where rates started talking about maybe 3.75. So this is about a quarter point in rate shift here, which is dramatic enough as it is. And then after, day of the election, markets close. Obviously, the election results didn't come until after the markets are closed. And then the next day, gap down, fell off a cliff. Day after that, gap down further, falling further. And just today's Veterans Day, so markets are closed. I don't know what's going to happen next week. I'm hopeful that we're finding our floor and finding our footing. I think that something to pay attention to is a threshold in the 10-year coupon. Let me see if I can find data on the 10-year here real quick. Markets overview. Show the 10-year chart. If the 10-year exceeds 2.375 next week, we could be in for quite a ride. That's kind of what happened in 2013. We touched that threshold, and then just we went from 4.125 to 4.75 in like the blink of an eye. And that was what we called the, I guess it's not showing me the chart here, but that was what we called the Ben Bernanke taper tantrum. I don't know if you recall that, but we touched on those levels at that time, and we're very, very close to that today. So keep your eye on that. I think it'll hold, and I think it'll we'll probably hover around a 4% 30-year fixed for the rest of the year. But fundamentally, I mean, I think there's still a lot of reasons for rates to be low. But right now, we're all just calculating our paradigms, I suppose. This is one way to say it. So that's a big one. And one of the things that's already happened this week is Donald Trump and Nancy Pelosi have, I think, exchanged pleasantries and perhaps even discussed that one of their first items of business will be a huge national infrastructure bill that's going to put a lot of people to work, which is awesome. and we're going to reinvest in roads and bridges and buildings and things like that. And the way that those things are paid for is the United States government issues municipal bonds. So I think another reason why we're seeing, let me get that market back up again, let me get that chart back up, because it's so, Fannie Mae 3% show chart. One of the things that's about to happen in coming months in 2017 is we're about to be flooded with bond supply. So that some of the bond traders are incorporating that. I think that's influencing this year. So everybody's changing their strategy and rebooting on the fly. But let's get back to, so that's a big one. That's the first thing that that we noticed the day after the election. Another thing, so if we could dampen values of sustained, obviously. Another big one is regulatory rollbacks. The mortgage industry is heavily regulated by the federal government. And there's been a lot of changes since the Great Recession. So one of the big ones was the Dodd-Frank regulations. I think what that did was really separated banks from insurance companies, and it just I think it requires banks to hold a lot more capital and to act more sustainably, and to act without, to try to reduce their risk and be more transparent. And the big one for us is the CFPB, the Consumer Finance Protection Bureau, which was invented as a result of the Dodd-Frank legislation in 2009, and now is fully up and running and fully in charge of the mortgage industry. And recently, just like a month ago, there was a lawsuit. The CFPB fined a mortgage company called PHH Mortgage. I can't remember for what, but they fined, they levied a very large fine for their, that company was non-compliant with the existing regulations, so they fined them. And then PHH Mortgage appealed that fine, and it went all the way to the Supreme Court. And the Supreme Court found in favor of PHH, not the CFPB, and said that the CFPB's management structure is unconstitutional. So I think that, combined with the Trump administration and a fully, Republican Congress structure, could really show the CFPB waning in influence and power, and really, maybe even allowing mortgage companies to start doing things that they used to do 10 years ago that created a big mess. But maybe we'll do it better this time. I couldn't say. I tend to think not. So hopefully a lot of the new practices that we've put in place will stay in place. I think they're, on balance, have been very good for the industry, very good for home buyers, and good for America. So I don't know what's going to happen, but those are the things that I've got my eyes on. And thanks for paying attention. Thanks for your time. Give me a call. I'd love to hear your thoughts and get your feedback on how things are influencing you, how you're seeing this whole new concept of America and how that's influencing your business. Thanks. All right. Bye-bye.